Let me begin with a question. I ask students all the time, who is your lender of last resort? Now for me, the answer was my parents. Margaret and Francis Quinn bailed me out one time in a big way. When I ask students this question, most of them say their parents. So, my first point tonight is that if you're fortunate enough to have the lender of last resort, these lenders of last resort tend to have a parental quality. That is, assistance despite personal undeservedness. And during the recent financial crisis, lender of last resort reemerged as a concern. Tonight, we'll visit the past in an effort to understand the lender of last resort problem we have today. The other point I need to convey is the conflicted nature of the parental perspective. Why conflicted? Because an expectation of emergency relief can promote reckless behavior. This problem is called moral hazard. Moral hazard makes emergency bailouts and parenting a tricky business. Now let me take a trip through history to see how we got ourselves in the business of bailing out banks. In the 1800s, the Bank of England wrestled with whether to become parent to London's banks. On the one hand, the London banks were rivals. At this time, the Bank of England was a profit-seeking corporation, so why should the bank sacrifice itself to help others? And during crises in 1825 and 1839, the Bank of England did little to calm panics. On the other hand, the British Parliament granted the Bank of England privileges. Parliament asked why the bank deserved special status when it was unwilling to act as lender of last resort. In time, enlightened self-interest and political pressure led the Bank of England into a willingness to lend. This figure shows the amount lent by the Bank of England during the crisis of 1857. You can see the increase in lending, called discounting, in October and November. What about moral hazard? Red measures loan requests denied. So not all borrowers were accommodated. And all this got London thinking. And soon a journalist named Walter Bagehot suggested that the Bank of England handle the subject directly. From his position as editor of The Economist magazine and as author of the book Lombard Street, Bagehot proposed that the Bank of England openly pre-commit to being lender of last resort, but also raise rates it charges during a crisis. The idea being that banks would be calmed, knowing they could borrow if they needed, yet high penalty rates would discourage recklessness. Bagehot turned the lender of last resort into an idea, discussed by students of banking ever since. Interestingly, the Bank of England did not fully adopt Bagehot's proposal. The bank did act as lender of last resort, but the bank did not publicly commit to do so. And in this way, London muddled along and actually avoided the panics that were roiling the young giant on the other side of the pond. The United States had a different problem. The U.S. national banking system had no privileged bank. Instead, banks provided mutual assistance through clearinghouses, a sort of collective parent. This system nearly failed in 1907. Why? The shadow banks of the day, called trusts, lived outside the New York clearing house. When the trusts ran into trouble, they had no one to borrow from. And the failure of trusts caused fear to spill out to the wider banking system. The panic was finally arrested by the personal intervention of J.P. Morgan. If you will, Granddad grudgingly acted as lender of last resort. After the crisis, the large New York banks aligned with progressives in Congress to create independent reserve to act as lender of last resort. The Federal Reserve Act was passed in 1913. Learning from the English, we designed the Fed to be a lender of last resort that did not compete with banks. Clearly apparent, not silly. The first great test of the Federal Reserve came after the Roaring '20s. During the 1920s, a credit boom supported spending, houses, cars, and stock market. Indebtedness rose to new heights. The bust in 1929 saw stock market crash, banks fail, and people lose their savings. The unemployment rate rose to more than doubles today's rate. What did the Fed do? Like today, the Fed lowered borrowing rates to near zero for any member bank who wanted to borrow. Bagehot's high penalty rates were not used. Yet, few banks borrowed. Why? Many banks were small banks or savings societies. They were not members of the Federal Reserve System and did not have the Fed as a lender of last resort. Think of George Bailey's operation in the film It's a Wonderful Life. This outsider problem recalls trust in 1907 and foreshadows Wall Street investment banks in 2008. Also, banks resisted borrowing from the Fed. For borrowing signaled that a bank was in trouble. The Federal Reserve of the 1930s mistook this lack of demand for a lack of need. But banks, like children, don't always tell you when they need you. A lesson learned from the Great Depression was that a lender of last resort should not be too off-putting. While moral hazard may be a concern, the perils of insufficient lending may be greater still. You might view Lionel Barrymore's Harry F. Potter as an extreme example of a stern, unloving lender of last resort to be avoided. In the decades after the Great Depression, concern over lender of last resort, the FDIC introduced deposit insurance. The Federal Reserve turned to monetary policy. Money-making textbooks stopped discussing lender of last resort. It's as if the banks had grown up, moved out, and settled down to a quiet life in the suburbs. And then history repeated. Not particularly repeated. To paraphrase Mark Twain, history does not repeat, but it doesn't rhyme. So, the Gilded Age had shadow banks with no lender of last resort. Now, investment banks are front ranks, yet to the Fed, do not report. Then J.P. Morgan saved the day. Now J.P. Morgan Chase seeks prey. The 20s saw a housing boom. Home prices rose in the aughts too. Borrowing let consumption zoom. So gross domestic product grew. When GE was a new concern. And now with Google stock return. Then housing price increases stopped. And lenders cut Wall Street's money. Bear Stearns and Lehman Brothers flopped because lenders became money. In 07, trusts did panic. And 08 made Wall Street frantic. Again, scared banks avoided borrowing from the Federal Reserve. Again, the Fed did not immediately perceive that the children had gotten themselves into trouble and were making things worse by avoiding their parents. Once noticed, Chairman Bernanke tried to solve the approachability problem. The Fed experimented with auctions, loans to foreign central banks, even direct lending to shadow banks. But events moved faster. In March of 2008, Bear Stearns faced ruin. The Fed feared that the Bears' failure would set off a panic. So the Fed bailed out Bear Stearns. Yes, I said bailout. An act repugnant. But why? The act is a loan of last resort, an action we've often found commendable. Bear Stearns was undeserving, but all last resorts need look past merit. So what turned foul and act fair? I suggest rewarding bad behavior, that being of alternative. Although our central bank felt compelled to avoid systemic risk, such support created a destabilizing form of moral hazard. Too big to fail means a bank can secure a bailout by becoming reckless. Secure a bailout by becoming reckless. That perception was reinforced by bailouts of Fannie Mae and Freddie Mac in the summer of 08. And then, in September, the Fed did not bail out Lehman Brothers. Why remains unclear. The immediate effect was to reverse expectations. Too big to fail? Maybe not anymore. Uncertainty fueled panic as a recession became the Great Recession. Within days of the Lehman failure, however, too big to fail was back. Soon enough, we bailed out most of our largest banks. So let's repeat. We learned we needed a lender of last resort in 1907. So we created one in 1913. We learned we needed an accommodating one after 1933. So we got one in 2008. What have we learned recently? Too big to fail leads to big failures. So today, we are back to the conflicted nature of Walter Bagehot's idea. How do we help out without rewarding bad behavior? How do we reduce moral hazard and yet offer a trusted lender of last resort? I have no easy answer, or an answer not really. But let me close by returning to the parental perspective. Judgment of a child's behavior depends on maturity. An infant's tantrum is appropriate behavior. A preschooler's tantrum is bad behavior. Similarly, regulatory decisions in front of us now are more about the maturity of banks than about specific bank practices. Finally, metaphors are never perfect. Banks are not children. The Fed is not a parent. What do we overlook when we view lender of last resort from the parental perspective? Perhaps this: children grow up. Do banks ever grow up? I'm going to close with that disturbing possibility. Thank you for your time, and I'd be happy to take any questions.